Hello, everyone. Welcome to our first explanation podcast for Chapter 2. In Chapter 2, we're going to expand the tax formula that we learned about in Chapter 1, find out a little bit more of the details. We're going to break down those pieces so that we understand a little better how to calculate the tax for an individual on the 1040. So, jumping right in here. Remember that we learned about the 1040, that there is the basic form. We looked at an example of that in Chapter 1, and there are the 6 schedules for Form 1040 that explain or back up the numbers on the 1040. But what I want to make sure that we have in our mind is the idea of adjusted gross income, AGI. First of all, get that abbreviation in your mind so that when you see that, you know what that means, because it gets used all the time in the tax law, on the tax forms, everywhere. AGI is a really important, it doesn't directly determine how much tax it is because it's not taxable income, but it is important in multiple ways, and we'll see how that is. So there are specific deductions that can be taken off of our total income to get AGI. That part was not in our Chapter 1 discussion of the basic tax formula. So that's one thing we have now added in terms of our complexity, so we can deal with and see on our 1040 form. So it is, because 1040, the first page, ends with taxable income, AGI is a subtotal before that. And here's the thing. Not only does AGI a subtotal in our process, it also affects other deductions and credits that we will encounter later on. So here is our expanded tax formula. You see it follows the same basic outline as what we learned in Chapter 1, but with some important expansion, you might say. And here's where AGI is, okay? It is a step towards taxable income. So let me just give you an example of how AGI is even more important than we might think in terms of the process. So, for instance, if the tax law allows a deduction from AGI, our gross income, let's say, is $100,000, and we have permitted deductions from gross income that are $20,000, that would make our AGI $80,000. All right. Now, there are tax credits, especially, and even other deductions that are affected by how much adjusted gross income you have, how much AGI. Meaning, if your AGI is over a certain threshold, okay, then you lose some of your tax credits. So, for instance, if that's the case, then a deduction that is from AGI, okay, is more valuable because it also would allow us to have more tax credits later than that same amount of deduction as an itemized deductions, for instance, because that's after AGI. It's for AGI. So any additional deduction in this category will not change AGI. It will change taxable income and save us tax, but it won't have the double situation of reducing our taxable income and increasing our tax credits or some other form. So as we learn about tax credits, as we learn about some of the itemized deductions, many of them are calculated with reference back to this AGI. And so a change in AGI has a much bigger impact on your tax return than something that is not for AGI, or from AGI is the term we use. All right, so here's our formula. Broke out some detail on tax credits, other taxes, tax payments, refundable credits. We still have two types of deductions, those that are for AGI and those that are from. Standard deduction is from. So a basic tax return is still gross income, and then the standard deduction like we encountered in Chapter 1. Now, filing status, and this is important for determining not only the standard deduction, but also which column to use in the tax table or the tax rate tables. So we've had a little experience in using those tables, and they are broken down by filing status. So, first point when determining status, it is what is in place at the last day of the year. So you look at their married status of the last day of the year. Divorce being finalized, okay, on December 30th means you are single on the last day of the year. If you get married on December 31st, that means you're married for that year. Doesn't matter, you were single all the rest of the time. You get married on New Year's Eve, okay, and then you are married according to the tax law. And you cannot file single. It's not like you get to choose. It has to be based on your actual status. So if you get divorced, you are single at the end of on the last day of the year. If you get married, you are married. All right, so single and married filing jointly, kind of the most common. All right, you must be legally married, and the marital status is determined by the state, under the laws of the state. So we find that happens fairly often in tax law. The federal government does not, at least in the tax law, does not necessarily go in and try to determine definitions of various things. They basically say, refer to your state law. So if you live in a state that, and this is when marriage is recognized and that sort of thing, then that's what you get to use for your federal situations. And we'll find that later in adoptions and other rules and the federal definition follows whatever the state definition is. Okay. Now, married filing jointly, the key to remember is when you file jointly, this means that both spouses are really filing as one person, and they are jointly liable for the income tax, regardless of who has the earnings. Only if there's only one income, or if they're both having income, doesn't matter. The liability is, they can go after either one. So that's a joint liability. If one can't pay, the other one is still responsible for it, if it comes down to that. So that's usually the most advantageous if you're married status. Now, there is married filing separately. Now, notice this is not single. This means you are legally married at the end of the year on December 31st. So if you got divorced and it's final, you cannot use this status. You are not married. So you elect to file separately. This is usually not a good situation to use, all right, because the tax law has written in some, you might say, penalties. It's the idea that there are two tax returns to process rather than one for this married couple, and that just means twice as much work for everyone. So there's some kind of penalties, and we'll encounter them. Occasionally, it may be better off for someone who is married to file separately than jointly, but it's pretty rare. All right, and you have to show the Social Security of your spouse that you're filing separately anyway. Even though you file separate returns, two different documents with the IRS, they're going to want to match it up and make sure that you don't do anything, that you don't double count anything. So, for instance, if your standard deduction is going to be half if you're married filing separately than it would be married filing jointly. So, literally no difference, if you will. If you itemize, we'll get into itemized deductions in Chapter 5, and you use the highest, either itemized deduction or standard deduction. If you use itemized deductions as a married filing separately, your other spouse must also use the itemized deduction. It cannot use the standard deduction. So if you file separately, it doesn't get one of you to be able to use the itemized deduction, then one of you use the standard deduction. That's not allowed. So that's one of the reasons why there's really not that much reason to do so. The key thing is, in these cases, is you're not both jointly responsible for each spouse is responsible for their liability, how much they owe. So some situations where perhaps the marriage is still intact but is not doing well, or you're not sure that you trust the other one, then it might make sense to have a separate return with separate tax liabilities. Head of household. Notice this is unmarried. This is a single individual. So this is not for someone who is legally married. Okay? Except in a situation, okay, where what we refer to as an abandoned spouse. Okay? And that is a situation where one of the spouses runs off and leaves the other one with the kids and disappears. So you can't file for divorce, can't make that happen, and yet by all legal standards you are single and divorced, even though you cannot make it stick because you can't find them, or they're avoiding you, or whatever, that sort of thing. So that can be unmarried if you live apart, and they basically made it very difficult for you to file for that. So to be head of household, got to be single, except in that situation I mentioned. Must be U.S. resident or citizen, and you have to maintain a household for a qualifying person for more than half of the year. And we'll talk about what a child or a dependent is. It has to be someone you can claim as a dependent. And so that means that we have to define that, and that will come in a later slide. But you have to maintain a household for at least one other person. So if you're by yourself, then you're single. You're not head of household. Head of household is for a situation where you are providing a household for another dependent. If that dependent is your parent, they don't have to live with you. As long as you provide support and they qualify as a dependent, they could be in a care facility or some other place as long as you're providing the support. So that means that you could still be head of household even though in that situation, even though you're by yourself. And then the last filing status, really, as I mentioned in Chapter 1, not really a filing status. It's kind of permission to use the married filing jointly status even though your spouse is gone, even though they have passed away. And this qualifies widow or widower with a dependent child. And the key thing is there has to be a dependent child. This cannot be just you lost your spouse. Then in the year that they passed away, if they pass away, in the year they pass away, you can file jointly for that year and no longer. So you get the last year, the year of death, As long as they died sometime during 2020, then you can file jointly for 2020. 2021, assuming you're not remarried or anything else, you are single, no longer married. But if you are supporting a child, meaning in your home, then you get a break, if you will. And they say you can use the married filing jointly status for 2 more years. All right? So you have to have been eligible to file a joint return. You have to stay unmarried, meaning you don't get remarried, because if you remarry, then that becomes your status. Right? And you have to then, as it's here, to support that place for you and the child. Okay? Parents, cousins, other people, okay, unless they qualify as a qualifying child, don't make you a qualifying widow or widower. So that's that thing. And notice it's not just about losing your spouse. It's about having a dependent child as well. Now, how do we determine who are dependents? It's typically think of those that are living with us or in our family. And over the years, this definition has gotten more complicated and evolved as more and more different situations happen. So this will give you an idea of what is involved in the various definitions. Okay? So this is important for credits that we're going to learn a lot more about in Chapter 9. As we found out, to be head of household, you have to have a dependent, and so that's important for determining our filing status, or also for a qualifying widower. And there's some other areas where it's important. So the dependent must be a qualifying child. There's 2 qualification methods. You can either be a qualifying child or a qualifying relative. All right? Now, overall, the person that is your dependent cannot be the dependent of someone else. So, this is one area of the tax law where the dependent can only be claimed by one other person or one married couple. It cannot be that you split it. There's no halvesies. There's no, both qualify. In fact, in the tax law, there's actual tie breakers because there is no tie in this. You're either a dependent of one household or another, not 2, not partially in both. All right? There's a joint return test. You cannot be a dependent as long as you're filing jointly with your spouse. So if you're married and filing with your spouse, that generally means you cannot be a dependent of someone else. However, if you are married and living back with mom and dad or grandma or something, you could be a dependent if your income is low enough that the only reason you had to file a tax return jointly with you and your spouse is to get a refund, meaning you did not have enough income that you needed to file based on the filing requirements. So your income is pretty low. And you have to be a citizen, and you see where that is, and they've made that an adopted child, okay, household, that sort of thing. So those are the basic things. If those aren't the case, okay, then it doesn't really matter to go any further in these definitions. So always want to see if an individual fits or dependent fits the qualifying child. It's best to be a qualifying child. For instance, that the CARES Act for 2020 sent $1,200 to everybody and $500 per qualifying child. This was the definition. It was not a qualifying relative, it was a qualifying child. So this is the better of the thing, because there are situations where qualifying child works and a qualifying relative doesn't, even though it still would be a dependent. So qualifying child has to meet a relationship test. Now, the relationship test is broad, but it does include a lot of folks, and the list you can see in your textbook. Okay? The key here is the relationship test is fairly broad, but there's an age test. Okay? And the age test has got to be under 19 or under 24 and a full-time student. And that's critical. So you can see we are talking about someone you more likely would think of as a child. All right? They must be resident of the United States. The support test is kind of flexible. Basically, it means it says no one else is providing half of the support or more than half of the support. It does not say that you are providing half. It just says no one else is providing more than half of the support. So if you fit this age test, your support test is pretty flexible, meaning you don't have to prove that you are providing the support, just that somebody else didn't. That's a lot easier to show than to show that you did. Okay? There are tests when this works for multiple people. Okay? Divorced spouses, okay, who share custody. There are tests to determine, okay, who gets to whom they're dependent. Usually the one that they live with the most, that has the longest custody. And then if it's exactly even, there's actually a tiebreaker in that who has the most AGI and things like that. So there's lots of rules about how to deal with the difficult cases. By and large, the cases are pretty straightforward. And of course, there's always oddball ones where you have to really dig in and look through the definitions. But most of the time, it's those that are living there. Okay? Now, notice there is nothing in the qualifying child about income or anything like that. All right? That's different when you get to qualifying relative. Now, the first thing that listed says it's not a qualifying child. Well, that's kind of, you wouldn't even be looking at qualifying relative if it was a qualifying child. You would stop there, if they're a qualifying child, and you'd say, oh, they're a qualifying child, there must be a dependent, we're all good. So this is, yes, you wouldn't even consider this, but don't think of it as, oh, well, therefore, if it's a child, they can't be a qualifying relative or something like that. Just think of it, I would not consider the qualifying relative test if they pass the qualifying child test. Okay? So there's still a relationship. They still have to be a relative, and there's a list. A lot of, in-laws and stuff and things are included, some are not. You have to look at that. But they don't have to be a relative if they are a member of your household for the year. So this is the situation where this could be somebody that you knew, a child of a friend that you let live in your home because something happened to your friend. And because out of the goodness of your heart, you let them live in your home and provide them with a household for the entire year. They would not need to be a relative, even though they're going to be called a qualifying relative under this, because they're a member of your household. Here's the kicker with this thing. If they don't fit as a qualifying child, they fit only as a qualifying relative, then they can't make too much money. They cannot have gross income equal to or greater than $4,300. So that child that you let live in your house that's a friend, that would be fine until they got a job where they actually made more than $4,300. And then they would no longer qualify. as a qualifying relative and therefore as a dependent. And the support test is a little stricter in that you must show that you provide half of the support. Now, there is a way where there's a multiple individuals provide support. Like, say, mom is in a nursing home and all the children provide support. They have to still be related, and there still has to be at least a group of them that provide 50% that fit that relative status, and then they can agree among themselves who's going to, that grandma or mom's going to be the dependent of each year. The fairest way would be to rotate. So if we all provide 33%, none of us provide half, but we could sign an agreement that says we'll take turns once every 3 years of having mom be our dependent. Okay? And that sort of thing. So you have to look at the test, the support in those cases. Again, it has to be, they have to be related. It can't just be random folks to do that. And the person that gets it has to be over 10%, and as a group, it has to be over 50%.